Hey, welcome to the podcast, everybody. Thanks for joining me. Appreciate it. Today is Thursday, April 26th, and as you can see, another green day. Perhaps the little mini correction is over. Got some big economic data coming out tomorrow, but we'll talk about that in just a minute. Let me run down some of the numbers. Dow Jones Industrials finished up 113, about 87 basis points. The utilities were up. The S&P 500 is up about 0.2%. And you see the lonely red number on the screen, the Dow Jones Transports, which has a lot of people talking about, hey, you got commodity stocks still falling. A lot of those got hammered today. And you have transports falling. Even though the rails are doing really well, and we'll show that in a minute, transports overall are falling. So is that a warning sign? And then as we go through them here, you can see financials up pretty good, biotech up pretty good, and of course the Russell 2000 and bank stocks. So pretty broad-based, but like I said, you do have some of these issues with commodity stocks and transports, so that could be telling you, hey, there's warning signs out there that for those people that think the economy is rip-roaring, perhaps it's not. Now, the day did start out with some kind of mixed data. We had the initial jobless claims, you can see, came in at 388,000. Of course, that number should be going down, not up. So not only was it higher than the estimate of 375,000, but it was revised up by another 3,000. So that's been trending the wrong way for the bulls. Bulls did get a little bit of improvement on pending home sales. And I think, just to sum up what I think about homes, there's a great debate whether it's bottomed or not. And, of course, the housing stocks have done fabulous. Of course, the Home Depots and Lowe's, a lot of people are saying, well, it's just speculators. It was really, really good weather the first quarter. Maybe all of that. But the bottom line is things have definitely improved in that area. But, if you have something that's sloping downwards and all of a sudden it's flatlining now, it's an improvement. That doesn't mean, though, that the housing market is healthy, but some of these things, especially at least where I am, and talking to a lot of people in the housing business and a lot of people that are realtors and so forth, things are vastly improved from even 6 months ago. Now, that could be very, very regional. We know that real estate, location, so I think that is the case here. But certainly this is something that people are looking at going, hey, maybe we're at least getting better housing data, and we're certainly see it when you look at the pending home sales. Some of these things are being revised up, some are being revised down, but overall I think the trend has been improving overall, and I think that's something that the bulls are encouraged about. Now, one thing that the bulls cannot be encouraged about is this initial jobless claims, which we talked about, and I showed this, I think, last week, because this is a number that comes out weekly, and what I've got here is the, again, inverted initial jobless claims, which is red, on top of the S&P 500. And what you can see from the red, now this is a 10-week moving average in the red. It's not the claims every single week. It's actually the moving average. And what you'll notice here is it's rounded off here. So again, we've had several weeks in a row where this data is coming in higher, or because it's inverted, lower. But these numbers are coming in higher, more people filing for unemployment. And so as you can see, it's starting to roll over, which is why you're starting to see the market get a little bit more turbulent, we'll call it, for really the first time this whole year, 2012. And for those that are new to the podcast, remember that if you're looking at this saying, well, wait a second, you're saying initial jobless claims getting worse, but the unemployment rate we hear on TV is getting better. What's the disconnect? The disconnect is you have a lot of people that are simply dropping out of the labor force, not even looking. So there's so many people that aren't looking. So when you have fewer people looking and those that are still looking are getting some jobs, the unemployment rate drops. That's the disconnect. So what we like to look at is we like to look at the underemployed, plus we like to look at that rate of people dropping out of the labor force, and then we like to look at the initial jobless claims. We put all that together, and what you're seeing is there was an improvement in the last few months, and now it seems to have stalled, and I think a lot of the economic data we're getting in the last few days is pointing to that, which is why the stock market is starting to kind of move sideways, and that's the bottom line of why. Remember, we came off of last summer just really bad numbers, and you can see here the initial jobless claims were racing up, course, it's inverted, led to the stock market selling off, and then it started to improve. And so as that's improved, the stock market has said, oh, good, yes, Europe is a problem, but we know that even if our economy does slow down, Big Ben Bernanke is going to be there for us, right? They're calling it the Bernanke Put, which essentially means the market can only go down so far before he comes in and floods the market with more money. And as he does that, the stock market likes it. So this put, usually you see call options and put options have an expiration date. Uncle Ben said that the expiration date is maybe 2014. Maybe it's longer than that. Remember, that's where he's talking about raising, short-term rates. He hasn't talked about long-term rates. He could continue to do this. So some people are saying, wait a second, does that mean QE3 is on the table, off the table? I don't think we need to even get that detailed in it, because the bottom line is that he whatever he calls it, whatever he's doing something, and he's going to be there. So if the economy rebounds and gets strong, great. If the economy gets weaker, he's saying we will do more. And so the stock market's saying, well, then what's the problem here? What's the risk? and to some extent you have to agree. However, that doesn't mean that you buy stuff and walk away. You still have to pay attention, because even during these times, he can print what he wants. But if the economy starts to get weaker and accelerate to the downside like it did last summer, he can't print fast enough to stop those types of corrections, even if they're corrections. 20% is what we got last summer. So even if you say, well, he's going to be there for us, this can continue on for some time, maybe you're right, but that doesn't mean that we won't get 5, 10, 15, and even 20% corrections, even if he's there continuing to print money. And he basically said he's going to continue to do that yesterday. Hence, the stock market is continuing to go up. So let's first check in, before we get to some specifics, let's check in with the just the overall stock market. And you can see that one thing that I had talked about last podcast was this potential for this head and shoulders that was here, here, and here. Now, what's happening is, if obviously to complete that, this would have to start, working its way down, and that would complete the head and shoulders. We're not getting that right now. And because we're not getting it, does that completely take it off the table? Well, not necessarily, but certainly the pattern is not holding up. In fact, today, not only did we break out of a little, I guess you call it a little box, a little trading box that we've been in for a while, but you're starting to see the market turn back up. The 20-day moving average may start to turn up as well. But this is the sideways kind of consolidation pattern we were in really for, the last 10 or 12 trading days, as the bulls would have a good day, then the bears would come in and say, no, not so fast, and it would look like we were starting to make lower highs. And that's indeed what we were making. As we see, we had a high here, we bounced up, had a lower high, came down, bounced up, and we got pretty much to the high end yesterday, and then today we broke out to the upside. We're not seeing the dramatic quality that we would like to see. There is some selectivity, as I mentioned, when you talk about commodity stocks, when you talk about some of the transports and things like that. So that's still a concern, wanting better quality, but you're not getting the intense selling either. And the fact that we are breaking out of this little area is encouraging. And so there's a lot of charts that are looking good. This is the first one here. This is the Dow Jones railroads. You saw good earnings coming out of the railroads, and again, very cyclical, obviously. And this is what a lot of the traders are looking at, this type of breakout here. So we've had this little downtrend. We obviously had the 200-day moving average, which it bounced off of twice, and it's broken out to the upside. Companies that are in that, if we look at things like Norfolk Southern, easy for him to say, and you're starting to see the 20-day moving average cross the 50. It's kind of gapped up. It's hard to buy. So what you would want to do on something like this, if you're looking at that area, and I don't own these, by the way. I mean, I didn't buy this gap. Moved up again higher today. What you want to see is a pullback to here, and then maybe then start to take off. That's where you would look to buy that, because the earnings were fine. Great company, no problem. That's what you would look to buy. And a lot of them look like that. I think one that's really interesting right now is Kansas City Southern, which, if you see here, it had this almost potential for a triple top, and it broke through. So again, what we want to do is let it go up a little bit, come back down. If it holds the $75 range, then that's your entry point on Kansas City Southern. So that's looking good right now. Now, before we get to some other ones that I think are looking pretty good, let's talk about Apple. This is something that I talked about in previous podcasts. I had mentioned the fact that potentially this 550 to 560 area was going to be the magic place it pulled back to. Lo and behold, it did that. And, of course, the question I got was, hey, did you buy any of that on the pullback? And the problem with Apple was you came into that day, it pulled back right to where it was an excellent buying time. However, what did we hear? First, we heard the AT&T and both Verizon were talking about iPhone signups, and there was just some warning signs there that they could potentially say something that wasn't great. And remember, they could have come in and beat estimates. I think they had to crush them to get the stock to move, and they did. They guided down next quarter. They're probably masters of doing that. But again, it was a concern, and so I hate to buy stocks the day before they're about to report earnings. If you're going to do one stock, yes, I would admit Apple would be the one you would take that risk on. I didn't do it. It gapped up, and now you see that it gave $2-3 back today. And a lot of these moving averages are still starting to at least look like they're rolling over. But many believe, and I agree, that it could be in a trading range for a little bit here and maybe just move sideways. We'll see. I mean, we didn't see the follow-through today. The interesting thing also yesterday was that it gapped up in the morning, and then it just moved sideways. So it was up about $50 at the open and moved sideways. So those that are quicker took the profits. Yes, I would have loved to have been an Apple, but I'm not looking to day trade Apple. I'm looking to get into it for a little bit longer of a trade, and because of that, I didn't want to do it the day before earnings. It could have easily blown up. Now, one solution would be perhaps buy half your position. That could be, but I really am hesitant to buy stocks on the day before earnings. One stock that I do own, which I've owned for a while now, is Amazon. They just came out with earnings after the bell. Their stock's up about 10%, so the earnings must be pretty good, I would suppose. I guess they're not awful. And this is a stock I bought. Yes, fundamentally I like it. It's kind of one of those real skittish stocks. Sometimes they say something that disappoints and the stock gaps down after earnings. Sometimes the street loves them. I was looking at this technically. This is the pattern I saw here, which was this little wedge where it was becoming more and more narrow. It broke through it. That was great. Went up above the 200, looked like clear sailing, came back down to it, and now you see it's turned the corner, and it was up today on increasing volume. So, assuming that they don't say anything too bad in their conference, the stock should open somewhere hopefully higher than this and make a new high tomorrow, 213, 215. So, but I like this setup. So that was one that I own in full disclosure. I own it for more of trading aggressive accounts, and I've owned it for a while. But again, would I have bought it today? That's a risky thing because they could have easily gapped down. The options were pricing in about a 7% move one way or the other. You're actually getting that, but it's coming to the upside. But it could have been to the downside. So you're better off waiting for that. And now that you got earnings behind you, then the market will focus on other things, and this can trade on more technicals than fundamental. Now, a stock that I actually bought today, again, for more of a trade, it's a great fundamental story, and I really like marrying the two where you get a great fundamental story and you get a great technical setup. A company called Darling International, I actually have owned their bonds for quite a while, but this is a company that is in the waste management business. They pick up grease from restaurants. It's a glorious job. I'm sure the guys that do that smell great once they leave the facilities. But they pick up grease, and you would say, well, that's neat. But what do they do with it? Do they? Is this? I picture kind of like a Randy Quaid driving on the street, with the hose hanging out the back and all the grease is shooting out the back accidentally. But they pick up the grease from restaurants. McDonald's and Burger King and all these places have grease, right? They need to get rid of it. And so they pick it up, and not only do they charge a fee to do that, they actually go and then they can sell that and turn it into other products, as we know, biodiesel and things of that nature. So an interesting company, great fundamentals, and the stock had really recently taken off. It had hit a low of $12.07 back in December, and then here recently on March 26th, exactly a month ago, it hit a high of $18.22. So you're talking a 50% move in just 4 months. It was a great move. And now what you have is you have the stock which has retraced, to the 38.2 level, which is kind of the first retracement. So it's given back, about a third of these gains. And now it looks like it's turning the corner. So this is kind of an easy one where you would say, hey, and I shouldn't say easy. That's like saying this is going to be an easy golf shot, and the golf gods say, aha, okay, this one's going in the trees. But what I'm saying is this is an easy setup that I like, which is it ran up, it sold off, it looked like the run was completely over. Great fundamental story. Could be turning the corner here, and then you've got an easy place to put a stop. Let me use the word easy for your stop, which is somewhere in the high 15s, below this area right in here, because that was the, a little area of sideways, and now we're back to that. We've moved sideways here, so it's ready to take off. If it doesn't take off, guess what? It wasn't time. You get a stopped out on a smaller piece there, smaller stop percentage-wise, and you move on to the next trade. But full disclosure, I did buy that today, so keep an eye on that one. This isn't a recommendation to go buy it. It's just this is a nice chart setup. So there's a lot of stocks that look that way. So search through your charts, and you'll see a lot of stocks that have that setup, that have run up. They sold off during this little correction, and they're primed to be purchased again using stops, because if the overall market gets weaker based on bad eco data, of course it's going to take everything down with it. But there's a lot of stocks out there that have sold off that were running, and those stocks that you wished you had 3-4 weeks ago, you're now getting your chance. Tomorrow we have GDP quarter over quarter annualized. It's supposed to come in at 2.5%. And you have a confidence number, 75.7 for University of Michigan confidence number. So here's that number. Here's the that number, GDP growth. And again, I've showed you this many times. It's the S&P on top of that number. So we want to see that rising. It's supposed to come in at 2.5, which would show a little downtick down to about here, according to my little pointer there. So a little downtick. And actually, it would be down over here, because here we are in time. So show a little bit of a downtick. If it comes out better, great. If it comes out much lower, then you start having this weakening effect. Now remember, this is one of those indicators I show you, and it's not to go, oops, it came out a little lower, so we must sell stocks. This is a very broad picture. In fact, look what happened in the mid-2000s. We were making lower highs all the way for literally 4 or 5 years before the stock market peaked. And I would say it was because we were averaging this 3%, and 3% was enough to sustain us with stocks going higher. Can we get that now? Can we stay in this 2 to 3 to 3.5% range? And if we can, I think the stock market goes higher. If it starts to continue to trend down and we start working our way down to 1, then people are going to freak out about a double dip recession. And remember, places like the Economic Cycle Research Institute have said that they are still saying we're going to have a recession in 2012. So that's why you're still getting this kind of tug of war, but overall the stock market has been ignoring what they said. I would have, based on last summer and fall what happened, I would have thought we would have been in a recession by now as well, and we're not. So it surprised me. That doesn't mean that I've shifted to this pro-growth bull. I'm just saying that, look, if we grow at 1, 2, or 3, the stock market, let's say 2 or 3, the stock market could continue higher because that's what we saw in the mid-2000s. So, the thing is, remember, everybody's pricing in that we would have no growth last summer, and we know Europe's still a mess. So if we can have any growth, our stocks aren't expensive. Are they cheap? No, they're not. They're not as cheap as they were in 2009, but we have some good companies, good balance sheets that are still cheap, doing a good job, and those stocks are getting rewarded right now. So even though it doesn't feel like a stock picker's market because the market's been trending up this year, I still think it'll turn out to be that, because there's individual companies doing really well. There's a lot of companies doing awful. And then, of course, you've got the ones that are getting beaten up because of what they do, whether it be materials or companies like that. So still be careful, but I think there are some charts out there that look very interesting right now. So don't be afraid to attack those if you have some stops in place. The only time you can't get stopped out, of course, is when you have, we're in earnings season. And when you have earnings coming up and it's a volatile company, you sometimes get companies that blow away to the upside or blow away to the downside. I've had a few of each. Actually, my only real blow up has been Netflix, which I own. But I've had a lot of really good ones. In fact, most of them have been on the good side. Netflix, not so good. Even though they beat on the earnings, it's costing them more to get those customers. So you don't necessarily want to sell those stocks when it has that. You want to wait for another opportunity for it to bounce. Small part of the portfolio, but again, something that is hard to control, which is earnings. You don't know how the market's going to take those. So that's one thing to watch out for in here. So it may be better to look for those good charts in companies that have already reported, as opposed to going in there and buying one that's just about to report in the next day or two. All right, guys, have a wonderful day, and we will talk to you soon.